happy to take any questions. So I'll start with the brief metrics of where we are right now. There was an interesting event that happened today that drove the sell-off. I don't know if you guys heard, but apparently the Biden came out with a plan to tax capital gains, and that's basically came out right after lunch, which drove down the S&P 500. They basically said they would increase the capital gains rate to something above 40% from sort of the normal 23-ish. So that's that. Interesting. It's unlikely to really stick, but who knows? So S&P 500 is close to its all-time highs. Triple B, so investment grade credit yield has gone up a little bit off its all-time lows. 10 years around 155, and that's sort of it's sort of been stuck there for a while now. The real rate, so the rate of the 10-year minus inflation is negative 75 basis points. So that means in real terms, if you buy a 10-year, you lose money. The 10-year break-even inflation is 2.3%, and I'll come back to that. Core inflation is at 1.65. Headline inflation is at 2.64. Brent moved back up to $65 a barrel, and gold is at 1783, still off its all-time highs for a while. So I want to show this graph to just to illustrate something that I found was interesting. So if you look on the right here, you've got essentially the deaths of the 1918 flu pandemic in the United States, and those deaths had about 3 waves. So the first wave, which happened right around the same time of year, sort of around April, March, had the first wave, and the second wave happened around fall of the next year, and then the third wave happened around the fall of the year after. And if you see, we're really following quite closely that pattern in terms of the deaths in the United States. So that would be the first wave. This would be the second wave. So if I were to point out where we are, we're probably about right here. So it wouldn't be surprising for us to get a third wave come next fall and next winter. So just bear that in mind. And then, of course, part of the reason we might get an increase in the third, the part of the reason we might get a third wave is that currently there's new variants that are spreading, so the worldwide deaths are actually quite substantial still. There's new variants that they found in Brazil and India that are quite virulent, and on top of that, it seems like the vaccination programs in India and Brazil aren't that extensive, so there's still a decent amount of risk to the world economy for a third wave. Moving on. So I wanted to come back to this, and this shows a few things, so I'm going to explain the graph. So the black line is the 10-year minus the 3 months, so it's the steepness of the yield curve. The blue line here is the change in the investment grade yield, so triple B bonds, and it's change year over year in percent. The pink, well, I guess purplish line is the credit conditions. So when it goes up, it tightens. The red line is the year-on-year change in the federal funds rate. And then the red line here is basically the stock market, or the Wilshire 5000. So, and I want to make a parallel between 2 periods of times. They have the same lines are true on this graph and on that graph. This first period is, of course, the COVID period, and this second period is the 1998 Asian crisis with the Russian debt default. And what you can see is that these 2 periods do resemble each other quite a bit. So if I go back to 1998, the credit spread started going wider, credit conditions started tightening, the yield curve had gotten almost to inversion, and started easing after the Greenspan came in. As you can see, the Fed started easing, and if you look at this period, it's sort of it's the same, except this is was done much faster. So the credit spread started tightening, and the stock market sold off much more quickly, and the Fed eased much faster. If you look at it, eased much faster than so that red line going down eased much faster in the COVID crisis than it did in 1998. So just to show you the parallel, and then we know what happened after 1998. So Greenspan eased the market. Then the market kept on going up quite substantially until it reached a peak around 2000. So there, call it about 2 years since the crisis happened to when the market toppled over. And the main reason it started toppling over is because, as you can see, this red line, the Fed started hiking rates again. Here's when they started proactively hiking rates. It took a little bit while, but it toppled the market. So if you think of those dynamics, just think about the possibilities that we're in a similar situation. We didn't really cleanse anything in sort of the zombie companies, the problems within credit. Nothing was cleansed during the COVID because the reaction was too fast. So we're sort of in a parallel situation with this crisis and the one of 1998, where we were seeing the market appreciate quite substantially. But there is a point where if valuations get too high, it might be problematic. So I went back and I looked at what was the appreciation from the bottom of the market to the top of the market. So in the 1998 crisis, the market bottomed from bottom to top was about a 68% rise. For COVID, this bounce has been 90% so far. So even higher than the 1998 crisis. Now, instead of taking it from the bottom of the market, because the sell-off point is sort of maybe an arbitrary position, but this is sort of what all the dynamics were before the crisis hit, might be another reference point. So you take it from the top of the market before the sell-off happened or the crisis happened, then you look at the top of the market until the next cycle. So that's about 30% for the 1998. And so far, it's only 23% for COVID. So just think about that. That you could say we have another 7% in us before we reach to the sort of the valuations or the move in the market post-COVID as we did post the 1998 crisis. Those are just reference points. Nothing's exact, of course. There is one thing to point out is that the Nasdaq behaved very differently from the S&P 500. So if I go back to 1998, you see that appreciation of 30% in the S&P 500. The Nasdaq on the flip side appreciated 224%. So the easing of the market, just like it has done this year, favored growth stocks and favored certain parts of the economy versus other ones. And if you look at the Nasdaq currently, that appreciation hasn't been as substantial, yet we know that the Nasdaq has increased quite a bit. It's only been 44% so far. And just bear in mind this almost exponential phase where if you look at the numbers, the Nasdaq almost doubled because this is logarithmic within a year before it peaked, which if you think about it, that's a big move. I'm too young to really remember that, but I'm sure there's people who've seen it and who remember it. And this sort of illustrates that point. So this is sort of the 1998 crisis. If you put on a percentage basis, the move in the S&P 500 and the move in the Nasdaq, it almost mutes completely the move in the S&P 500. So this is the Nasdaq here on the candles. This is the S&P 500 in the yellow bar. It's almost as if the yellow bar is flat and the Nasdaq is moving. And this is the same sort of overlay for the COVID crisis here, where the S&P 500 and the Nasdaq. So the effect isn't as substantial. But you could say that there's other things the market has been piled into, such as like cryptocurrency or renewables. Renewables have had a huge run, or anything that's related to the green economy. So when you're thinking about investing, also think about maybe pockets of the economy that might be in a bubble-like investment area, which if the 1999 crisis is an example, presents a great amount of opportunity because it can go up very quickly, but then it also has a quick crash rate. So where are we in terms of multiples? So the other thing, the way of looking at it is, what is the valuation? What is the valuation? So I've showed this graph before, but on the bottom line, essentially you have the multiples using the CPA tax, which is corporate profits after tax adjusted for after-tax earnings. And then on the y-axis, you have the 10-year future return. So each one of these dots is a quarter since 1947. And so what it represents is right now, we're sort of at this slightly 21.5 multiple, which would suggest that future nominal returns over the next 10 years would be about 6% on the S&P 500. So not completely as bad in terms of valuation as we had during the dot-com bubble, which is down here, and I'll talk about it more, but still not great. So if we were to take the 30 multiple, which is sort of the height of the dot-com bubble, and apply that to the current level of the S&P 500, that's another 27% appreciation that you would get from where we are today. So the S&P 500 would peak somewhere slightly above 5,300. Again, that it would have to go back to the multiple that was the highest multiple we've ever seen in the history of the U.S. stock market, which was about around that 30 level. Again, this does not compare to the Case-Shiller because it's a different way of calculating it, but it's a similar calculation method. So it's basically using the 15-year past earnings, adjusting them for the inflation, and then looking at its multiple versus the current price. One of the things that it's worth pointing out is that earnings are being reviewed positively, more so than they've ever been. Usually, this graph shows basically if the earnings are upgraded or downgraded. Generally, as you get closer to the earnings release, they get downgraded. Here, they're getting upgraded. So we're in a positive earning momentum. So bear that in mind. So this is the same data that you have on this graph, but instead on this graph, what I've done is that I've used the regression, and that's in yellow, and in blue is the actual 10-year future return. So you've got it time since 1947 when the data series starts. It doesn't start at 47 because you need a little bit of data to be able to calculate this information. And then here is the 10-year future returns. So the blue line is the actual future returns of the S&P 500, and the yellow line is, or orange line here, is the predicted one by the model. So currently we're at that 6.1% return for the next 10 years. The previous lower bounds of those were during the dot-com bubble, as you can see here. And the other one was in sort of October 64. So if we were to take the October 64 multiple, that would translate to 4,700 on the S&P 500, or another 12% up. So we still have some room to appreciate. It doesn't seem like the Fed is wanting to do anything about it now. So right now, there doesn't seem, and earnings growth are in a positive momentum. So it doesn't seem like there's anything to stop the market. But there is, we're getting to valuations that are not crazy historically, but that are starting to get punchy. Because if I were to draw a line here, you could see that there aren't many other periods in history where this orange line has been lower than where it is today. And this is post-World War II data. So if we look at October 64, which was basically this data point, what was October 64 like? So October of 64 was somewhere around here. And the reason you had a low period where returns weren't very good is you entered the stagflation era. It wasn't quite stagflation yet, but it was the start of that stagflation era where basically the Fed kept on having easy monetary policy, and stocks couldn't really appreciate because there wasn't a substantial amount of growth. And if you take the parallel, so this bump here represents this move up here on the yellow and blue lines, and then this drop here would represent this move up. It's sort of inverted because as the market drops, your expectation for future returns increase. And then so what you see is that during these periods, the future returns didn't really move very much. So the stock market, because the stock market didn't really move very much, and earnings growth went nowhere. So the reasons that the future returns increased during the sort of the 67 and the 70s is because the stock market had some drops with earnings increasing, but the stock market just wasn't revaluing up. So if I go back to what did the economy look like in 1964, just as a parallel, I'll go through this graph. So in red, you've got the stock market again. And this time it's the Dow Jones because that was more prevalent at the time. In black, you've got the 3-month Treasury. In yellow here, you've got inflation. In purple, you've got the Moody's yield. And in blue, you've got unemployment. So in the 60s, you also had that sort of high unemployment level. Unemployment was around, if I take it here, around 7%. And it was coming off. Inflation was quite low if you look at it. So that yellow line, inflation was around 1.25%, even in 1964, which is very similar if you look at what our core inflation is today. What did I say it was? It was our core CPI was 1.65. So we're sort of not too surprising there. And then as you can see, yields on credit stayed low for quite a long time and didn't move that much. And what caused the 1964 sell-off is that actually you started getting a little bit more of inflation expectations. As you can see, the yields start pumping up, and this inflation level starts pumping up. And that seems like a very similar situation to what we might be able to expect. Again, another parallel. And 1998 was a very similar occurrence when Greenspan eased like crazy in 1998 to avert a crisis. And then as inflation started creeping up, he had to hike. So the recurring theme here is that we're starting in a low inflation environment. We're doing a bunch of easing. If and when inflation appears, that's when the risk comes of the Fed hiking and the party stopping. So this is my own little sort of model that uses a few things to predict sort of what core CPI is. So this is the yellow line is what is core CPI. Sorry, the purple line here is core CPI. This is basically the background of the model. You don't really need to look at. The numbers that are important are this top part. The black line is basically what the model would predict. So it's done pretty well. It uses basically the ISM manufacturing PI, the New York Fed inflation gauge, and the real domestic product on a lagged basis, so that it predicts the future. So the model will suggest that we're probably around 1.5% by September, which we're already at on core inflation. It got completely offset by the fact that COVID just happened so fast. So a lot of these didn't get to adjust very quickly. But essentially what it's saying is that core inflation is still not too much of a concern. And over the sort of the next 6 months, it doesn't seem like we're going to be in at least from a course perspective, in a big inflationary environment. Now, you could be from a headline perspective, we're much higher at 2.6%, but headline factors in sort of commodities and food, which is not factored in on the core CPI. And the Fed looks at core CPI to determine policy. So right now, they don't seem to be too concerned. There don't seem to be too much inflationary pressures in the near term on core CPI, but they're coming sort of over the longer term. However, on the flip side, the market has already started factoring in an increase in inflation, and that's normal because it factors in headline CPI. So here you've got three different curves. The first one is the 10-year in black. The second curve is what's called Treasury Inflation Index Securities, or TIPS, which is basically the real rate. So when I talked about the 10-year at being 155, that's the black. When I talked about the real rate at minus 75 basis points, that's the gray. And then if you break them out, the nominal yield, or the 10-year Treasury rate, can be broken down into the inflation break even, and then into the real rate. So the inflation break even is the red line, and basically what it's showing is that people are factoring into their bond yields about 2.25% of inflation over the next 10 years. And that's gone ahead of where the market is quite a bit, as you can see with the purple line. I'll stop there to see if there's any questions, because we've covered a lot of material and I don't want to confuse, and I'm happy to go back on material. So please either throw something on the chat, or even better, ask a question by voice. I'll pause for a few seconds there.
Daniel, this is Bakul. Can you hear me?
Yes, I can hear you, Bakul.
So I know you were showing some recovery, like from just prior to the downswing in COVID, like the previous high. You were comparing that to what it is right now. One of them was like the S&P, like 23%.
So this one?
No, the next one.
This one?
Yeah, this one. Is it? Well, it could be anyone. But when you look at it from like 23%, do you track? Is it good to track how long it took?
I hadn't really thought about that, to be honest. I was sort of assuming that a 2-year time frame is probably similar.
Yeah.
I don't think it necessarily has to be, though, because part of it is valuation, or is the stock too high for people to want to buy more, and part of it is just momentum, and then the Fed hiking.
Right.
So those things can play out differently. But I did think that the 2-year time frame is sort of good to have in mind, how long it took for inflationary pressures to force the Fed's hand to reverse.
Okay. All right.
Does that make
Yeah.
sense?
Yeah, it does. So I think stock charts, when you use if you use stock charts, they have like a feature which is like when you turn on the crosshair, like you have,
Yeah.
you can go in both directions. So in one direction, you can tell, oh, this is 23%. Whereas if you go the horizontal direction, you'll know how many days or how many periods
Well,
it took.
it's here. It's on the graph here. So here it says 609 days. See that on the blue? There's a
Yeah,
609 here.
yeah, got it.
And then here it says 385.
Yeah, perfect. Yeah, I didn't see that. Thanks.
So yeah, time-wise, it would suggest we still have some time to go. I guess it would suggest that it's sort of beginning of next year is the critical period.
Right.
If you were to
Well,
do the parallel.
what I try to do also is look at my own portfolio in terms of if the aggregated beta value of my portfolio is, let's say, 1.25 or whatever it is, right? If I do similar characteristics when it reached high and then its recovery period relative to S&P, then I can also tell like how many days did it take for my recovery versus S&P or whatever the benchmark
Yeah,
is.
of course, that makes sense.
Yeah, thank you.
Oh, I got a question by the chat. Do you have a way to strip out the quantitative easing cash and just the sheer amount of free-ish cash available via the Fed when it comes to the future projections for the S&P over the next few years? P history may say 6, 7, these are unprecedented times. Actually, I'll answer that question actually later in during the presentation. So I guess I'll continue. Because that was almost the next slide. So this is the amount of quantitative easing given the different jurisdictions. So global and monetary fiscalists from February 20 to March 2021. So from essentially right before the COVID crisis to as of last month, the Fed has provided roughly 12.3 trillion or 57% of GDP. The Eurozone is provided about half, but still about the same amount relative to GDP. And Japan has provided 3.8, which is about 74% of GDP. And still the United States fares the most. I think that the quantitative easing helps, and the way I think about it is it's hard to translate it into increases, but if you were to take it away, the market would crash. But if the market crashed, I would probably think the Fed would start pumping money again until it was worried about inflation. So I think the most important thing, or the best takeaway to take, is what is the Fed doing? If the Fed is still concerned about a market crash, it's going to solve it. So I wouldn't be surprised that if the market crashes 15 or 20%, the Fed starts saying, okay, we need to provide support, in which case the market goes back up. But when inflation starts becoming a problem, that's when the Fed's going to start saying, okay, maybe we can't provide support anymore. It's a possibility that even in valuation terms, we go higher than we did during the dot-com bubble. It's not out of the question. But given the history, I think people would start getting worried. So I think this is because it's interesting to see that that's roughly when we started going negative. When the future returns went negative, that's when people essentially started saying maybe we shouldn't be doing this. So when your future expected returns are so low that there are no returns, it's only natural to sort of start saying, okay, I'm out. So talking about global and fiscal stimulus. So we saw that there was a huge amount of central bank stimulus, but also a huge amount of fiscal stimulus. And I'll drill down a little bit more into that fiscal stimulus because the Biden plan is to spend a lot in infrastructure. This is a breakout of the spend of the Biden plan. So essentially, these are the spending buckets and these are the revenues. So spending is call it 2 to 3 times more than the revenues. And the major beneficiaries of spending are here on the right, and they're put into different buckets. And now there's 2 columns. One that's the House of Representatives, or things that have gone to the House, and then the one that comes from sort of the Biden campaign. And so we can see that the 2 big focuses seem to be this sort of infrastructure around healthcare and childcare. And then the other another big bucket is sort of the transportation, which makes sense. And then the last big bucket is the clean energy, which are receiving really the bulk of all the stimulus plans. So when I was talking about areas that could be in in a bubble, construction, housing is a possibility. It's getting a huge amount of support. Clean energy, I wouldn't be surprised given what's happened. If you look at Tesla, that's a prime example of a stock that has a similar increase to what the Nasdaq did during its bubblish period in the 2000s. And but transportation infrastructure, I haven't seen too. This has been quite hard hit and doesn't seem like it's overvalued at this point. But so that gives you an idea of certain areas where where the government's gonna be investing, and providing maybe a potential backstop. But I mean, I saw an article by Schwab that was saying we might have the title was "Is Green Investing in a Bubble?" And I sort of see the parallels with sort of the 1998-2000. So this is the fiscal stimulus plan by the Biden administration, and you can see there's a big amount of emphasis on healthcare, infrastructure, and clean energy in general. So this is the split, and there's two sort of bills, the one that goes to the House and then the one for the Biden campaign. And the big winners seem to be clean energy, construction, housing, and then transportation and infrastructure. I wouldn't be surprised if we were in a green investment bubble. There was actually an article from Schwab on those lines that was asking if we might be in a green investment bubble. Housing seems to be increasing quite a lot these days, so I wouldn't be surprised that we might be also in an increased housing pricing range. I mean, they're just going. I mean, I think they said. I think my house, they said it went up 10% just last year. That's sort of not normal appreciation. And then finally, the last thing I was going to mention, because of the green investment bubble, there's an article that came out from Kathy Woods, who does the investments for the ARC ETF, which is a sort of a new technology and innovation ETF. And they came out with an idea that I really found sort of sounded bubble-ish. They came out with the idea that, well, solar plants have a problem because sometimes there's too much solar or too much solar power that's being produced on the grid, and they can't find a home for it because the grid is not adapted to that. So what she suggested is that you could put Bitcoin data mining centers next to the solar panels, so that when the solar panels couldn't produce power on the grid, they could produce power to mine Bitcoin, and that way you could create a green economy by mining Bitcoin and producing solar energy for the grid. That sounded a little bit far-fetched, but it came from a very serious sort of investment person. Have you guys heard any interesting stories of a green investment or a bubblish economy? But cool, I'm sure you've heard something. Come on.
No.
No?
I'd like to, but no.
So I just buyer beware on some of these sectors is all I'm saying. That we sort of went over. Yeah, so what I wanted to show is where the Fed is currently. And so this graph is, and this you can find on the CME Data Watch, which I've showed to you guys when we were at Skirball a very long time ago. But this is basically the dot plot, and this is publicly available information. It's basically all the FOMC members, so the people on the Fed that vote for the interest rates. They basically, each time they say where they think interest rates will be on a forward-looking basis. And each one of those dots represents one of the voting members on the committee. And so what you see is that the Fed assumes that essentially we'll have zero interest rates until 2023, and that at some point, they don't know when, they will start thinking about raising interest rates. And if you use market instruments to see what that looks like, so the Fed essentially says it's not raising before 2023, and then it's going to go up in the longer term. So that blue line is essentially the replication of those dots, or the blue dots. And then that yellow line is they use basically Fed fund futures and Eurodollar futures to determine what the market would estimate the hikes are. The market, because of the inflation expectations that are rising, estimates that they're going to rise rates sooner than the Fed thinks. So there's a slight disconnect there where the Fed thinks it's going to stay lower for longer, and the market thinks inflation is going to come sooner. So you just have to bear in mind that this hike in interest rates might actually come sooner than the Fed anticipates. Oftentimes, there's a market. There's sort of a compromise where the market strong arms the Fed of hiking before it really wanted to. And then to point out there are some inflationary pressures or speech, just to highlight sort of the flip side of things, is Fed Bullard, which is a voting member. on the FOMC says that if we reach 75% vaccinations, he would allow for a taper debate, or he would think that it would be good to have a taper debate, so to stop easing and to pull back some of the monetary stimulus. Likewise, what we've seen here is wages create often wages are often the thing that creates inflation. If you savings often don't create inflation, but wages do create inflation. And what we've had is, because of COVID was government payments, those go onto your bank account and they don't translate, especially when you're locked down, into consumption. And people tend to save money that's given to them rather than spend it directly. But when they have a constant wage that pays them, that's when they tend to increase their consumption, which produces the inflation. And so if you look at the two surveys here, you've got NFIB small job openings hard to fill. So basically something that represents employers looking for jobs. So basically a potential increase in wages. If there's more and more jobs hard to fill, they're gonna have to increase wages. And then small business compensation plans. So basically what they're paying people, or what the current wages are. And what you see is there's currently a disconnect where companies aren't really paying to fill the jobs that they need. So what you would imagine is that as jobs get harder and harder to fill, wages go up and create that inflationary pressure. Does that make sense? So there's also the question of who's going to be hit and what's going to be hit by taxes. So the current administration's taxes would potentially hit mostly sort of those areas that have a tendency of maybe being more overvalued than others. So communication services and tech, which have had a great run, and then healthcare, and maybe hit less sort of the more traditional economies, utilities, and discretionaries, and then energy. So just think about, there's also two different places where you can be in sort of the economy and sort of sectors. I think, yeah, I'm going to end on this note. This is an interesting graph because it shows basically the different stages of the dot-com bubble through the NASDAQ. So this black line is basically the NASDAQ from 1994 to 2003. And it shows you basically the different events that happened. And the ones I'm going to point out is sort of that 1998 event where you had the Russian debt crisis. That was basically here. The Fed started easing right around here, so around, call it October of 1998. Amazon reaches $400. Now it's multiples of that. The Fed started tightening actually in mid 1999. Its first tightening was right about there, and yet the Nasdaq went on to fly at what we called about another 100% even after the Fed tightened. So just bear that in mind in terms of also milestones and sort of things that you're comparing. The Pets.com IPO, which marked the market top, happened right before the Pets.com IPO happened right before the market top, and Amazon started missing its earnings as well at sort of around the same time. Margin deck peaks, of course, right around where everything flips. It basically everyone's all in. There's no more money to buy in, and that's when things start rolling over. And so the Pets.com, I could maybe maybe we haven't reached that in sort of the green economy, although the combined solar with Bitcoin sort of does sound to me like Pet.com. Dogecoin, I don't know if you guys are familiar with that one, which is one of the cryptocurrencies. That sounds really a lot like Pet.com. It's basically a joke cryptocurrency that someone created that has a dog as an emblem, as its mascot. That sounds very Pet.com like. So there are some things that are starting to sound very much like this sort of era of just runaway stock market, and just money chasing too few opportunities. So I'll stop there if there are any questions, and I'll open it up to any comments.